Hi everyone, and welcome to another episode of the CEO's Address. Today I wanted to talk about something slightly different, but again on the same line or same theme of kind of the market infrastructure and the industry's kind of ways of doing things that audiences from asset managers or even retail community might be interested to know. But even within the industry, it's worth discussing the current state of how things work. So today I wanted to talk about how consensus views are formed, or at least how the general population in the oil trading community get their views or establish their views. So first off, it might be interesting to know that when it comes to the outright price of crude futures, namely Brent and WTI, that is where the biggest volume is traded, but it's actually the least known in terms of price discovery or the future price discovery or price prediction. It is mostly used for hedging, but of course there are speculators, but in many, many different ways, maybe looking to capture things from a systematic point of view or algorithmic or trend following. Very few are trying to actually call the market from a discretionary point of view, just kind of finger in the air, and even less do it very successfully. That all said, because it's so difficult to know where things are going to go, but the outright price is so important to people's economics, producers and users, or even trade houses, and everyone wants to know about the oil price to some extent. Where do we think things are going to go? So I would say the bulk of the infrastructure is around research houses and the investment banks. They are the most commonly heard voices when we talk about what's going to happen for the oil prices in the next quarters or next year. They report about the global oil balances, so supply and demand, come up with figures and kind of generically base their views on that. Joining me today is James Anderson, who is a relative value trader at Onyx Commodities. He was at Macquarie for a long time trading in a similar way, and before that he was doing analytics at BP. So he definitely knows what he's talking about when it comes to forming views, the underlying fundamentals and the rest. I thought we'd just dig into this a little bit with James straight away. And again, going from the concept that we've had a pretty big sell-off, like $10 per barrel from the peak roughly this year to where we are now. And to some extent, that was a bit of a restructuring of the industry's kind of alignment of where things are going. But just off of what I've said in the intro, like, how do you think the general market consensus is formed right now in a nutshell?
So personally, as you probably know, I don't trade much flat price, if any, just because I find it extremely difficult to call it right, and I've probably over my career got it wrong more times than I've got it right. So I don't even try to trade it, and I think that's probably the view in a lot of the big physical trading houses. I think people within the industry probably think they have more of an edge on individual time spreads, and probably time spreads kind of at the front than trying to trade flat price. And as you said, it's a lot of the desks I've been on, it's seen as a complete gamble, like trying to trade the outright flat price. I mean, I think this year's been super interesting. I guess we started the year and still have like an enormous amount of geopolitical risk. Refinery margins were sky high at the beginning of the year as well. So like you could even make an argument that crude was cheap, kind of relative to where products were pricing. Product stocks were really tight. Distillate cracks were super high. So I think flat price was probably reflecting that type of environment.
But then as we went into the year, the people kind of in Q1, or at least the end of the previous year, so end of 2023, you're going into the next year with people forming a consensus. And actually right now we are starting to form that consensus again. So pre-sell-off, it was starting to be talked about that actually maybe this 2025 demand is not going to be there. It's going to be outstripped by the supply. Like Goldman's were probably more on the bear side than they usually are, and things like that. And slowly we saw a kind of shifting sentiment that played out. But before that, we had the complete opposite, right? We came into the year off the back of 22, 23 of, relatively straightforward to be bullish in terms of, everything that was going on, like you say, geopolitics. But I guess where I wanted to start was like, everyone wants to know the top influencers' opinions on the supply and demand balance. I guess that's where people start. So the oil industry is very comfortable saying, yeah, basically on a global point of view, are we in balance, or are we in a supply deficit or glut for the rest of the year? And that kind of sets the tone for everything. And that was definitely bullish, right? And that was definitely, we're going to be drawing, we're going to be in deficit, and it's going to get worse as the year goes on, and then Q3 will be the peak. And to some extent that kind of played out. And then everyone's, okay, that's kind of done now. Let's focus on next year. And it's weird to say, 2025 views should be translated now, but it's just all about sentiment. But ultimately, I would argue, and this is probably like the first thing to kind of debate, I would argue that people are looking for that consensus. They're looking for research houses like Energy Aspects being probably the biggest, and then banks like Goldman Sachs, probably the biggest there, but also Morgan Stanley and others. They come out with their headline view, and people are seeking comfort in that view, and they will actually trade off the back of that view. And so therefore it does become a bit of a self-fulfilling game, but then there's also the dangers of herd trading and things getting overextended and underextended. So you kind of agree generally with that, or?
I don't know how many people successfully trade flat priced, just because personally I've not seen people to be hugely successful doing that. But that could well be just the environments which I've come from, that wasn't the edge that they've had. But presumably there's some hedge funds out there that are running good analytics and specific analytics.
Well, I could caveat that with saying, not necessarily a speculative view to say they're going to try and make money from that view, but it's, if I have to be long because I'm an asset manager that has oil as one of my risk parity investments, so it's either weighted 100, weighted 0, or somewhere in between, they'll be more towards the 100 side if there's a consensus that's bullish. And then you've got end users who, if they see that the consensus is very bullish, they might be convinced to buy that on their hedging, and producers might be the opposite. They might not sell because everyone's bullish. And that was actually what happened at the end of 2021. I remember Scott Sheffield, and I think others in the shale oil community were saying, why would we sell? Why would we hedge? Because all the banks are saying that oil is going to go to 150. So why would we not take part in that? So in a way, that's trading, right?
There were even some shale producers who bought back hedges towards the highs because they were so bullish.
But where they get, that's what I'm saying. So that's the bit to start. Do you agree? It's a bit of a sweeping statement, but at least from what I see, the market might be this huge commodity, the biggest commodity in the world, and a huge, huge, huge market. But at the end of the day, only a few people come up with the headline opinion, and people do tend to fall.
So I probably disagree with you there, that a few people come up with the headline opinion. I think the market is much bigger than that.
Okay.
And personally, actually, I think the sell-off we've had this year is probably more demand-led. So I think demand has massively disappointed, in particular for diesel. We've probably had negative global year-on-year diesel demand growth, but potentially partly offset by jet. But in my view,
the headline at the beginning of the year, like I was saying, that whole where are things? And people are looking for the research houses, a couple of banks, and maybe the trade houses in IP week to say, what is your opinion?
Yes, and as you say, a lot of people run balances. So say people take the IEA global year-on-year demand growth view, which I think they've been pretty slow to revise down this year. And I'm not sure if they're now even saying negative year-on-year growth in China. But I think before you hear it announced, a lot of people, especially at the physical trading houses, they'll have year-on-year, they'll have real-time demand data. I'm pretty sure some of the funds will run fairly snazzy analytics on what real-time demand is, and those indicators would have been pretty bad. So I would argue that we probably started seeing a sell-off in pricing reflecting that before you then begin to see this consensus view emerging, because I think it's probably further down the chain that...
Could I then suggest that, not to be provocative or anything, but it's that is the difference between smart money and dumb money then? Because the dumb money will say, what is the consensus view? What do the big guys say? As in what the most influential reports say, and I'm going to trade that way. Whereas everyone looking for an alpha performance, who doesn't want the consensus, as you just said, they'll want to know what that is, to know what the consensus view, but they're looking really to only really trade if it's something that other people have missed maybe, or at the very least an independent view. And as you said, if they're going to make money, it's not going to be doing what everyone else is doing.
I think without a doubt, if you're getting into a trade, at peak bearishness or peak bullishness, once all of that has been priced, then it's kind of a fairly fast way to lose cash. But I can't imagine there are that many people. I mean, there will definitely be some, but the people who trade like that over time just get taken out of the market.
But as I said, the people who they're not trading to make money, they're trading to make a decision on their business. So as in like, even for us, right, if we were hedging our FX, how do we come up with a sterling view against dollar? Like ultimately, we could just be like, look, let's call up Goldman Sachs and just say, guys, what do you think the view is? And you can forgive like big businesses who've got huge FX risk, foreign exchange risk. They got to form their view some way to know
my
when to
view on
hedge.
that would be on, I mean, FX, but I think you could say the same for oil. Is like, why are you even trying to form a view? Like the market is so liquid and, I mean, potentially so perfect. Yeah, why are you trying to?
So just to hedge 100%.
If you need to hedge, yeah, I'd hedge it at the prevailing market rate, or maybe you could buy dips or sell pops depending on what you're trying to do. But
there you go. So it very quickly forms into like, what is hedging, what is speculating?
well, you could just see over time. You could have one strategy that just hedges. You could have another hedges as you need to hedge.
Yeah.
You could have another strategy that.
But again, that definition of when to hedge at what time.
Well, yes, you can just track over time.
Yeah.
Is my just hedging when I need to, outperforming is me trying to beat the market. And if maybe you have a very good guy in finance who manages to do that, but I suspect over the long run, you'd just be much better off just hedging when you need to hedge.
From the evidence I've looked at, Ryanair do it very well. They're very systematic in their hedging. I might be wrong there, but that's what I've read when you read their reports and their approach to hedging. It's been systematic, and throughout all the dips, all the big rallies, they've not needed to chase them because they've just had a systematic approach to it. And I think they've done pretty well out of that.
But I presume that's also just rules based, so they'll have a certain amount. Yeah, they need to hedge.
Well, on the flip side, Southwest Airlines, I think it was, there was a big article on the FT bragging about how well they predicted the market, and they were trying to say we're like a hedge fund, which is contrary to how you think people should think, obviously.
So I mean, you're always going to get individual occurrences where someone's called the market fantastically and they've done really well. But personally, on something like flat price, I think over the long run, maybe there are some like highly gifted people who manage to do that, and they're probably like on a beach in Barbados. But
you're not going to stop people doing it, right? I think that's one thing I would say. Like no matter even at Onyx, it's not a huge part of what we do at all, but we will look for certain times to have a flat price view if we know we're getting a bunch of flow coming in or whatever. And I think a lot of people are like that. The opportunity.
I'd probably argue that it's a distraction, and like over the long run, I doubt it makes money. Yeah. So you're better off not having. That would be my.
I 100% agree, but as in like we know people do. So it's like saying retail guys shouldn't do X, shouldn't do Y, investors shouldn't do X. They're going to do it. So it's more like if we go back to the start, which is like, okay. At the very least, I guess the first thing I would say is, surprisingly, you don't, even if you are someone who thinks they know nothing about oil or you're new to trading and you start looking at oil, you think, how am I going to form a view that has any relevance? And I would argue actually when it comes to predicting price, and even in the more niche contracts, it's no one really knows. So at the end of the day, if you could just go and read the same things that everyone else is reading, which is basically what does Goldman's think, what does Energy Aspects think, Bloomberg will publish that, Reuters will publish that, everyone will know. And then that's what, I spoke to an asset manager on this kind of flat price idea, bullish Q3 this year. Yeah, I'm bullish, I think it's going to perform in Q3. Well, that's exactly what Energy Aspects said, and I think Goldman said as well. And then you can go and speak to someone who works at a physical shop who has the most amount of physical information you're going to have, one of the biggest trade houses in the world. Yeah, I'm bullish Q3. So it's like really, you can actually have all the information you need in the public sphere these days on that, because it's so hard. I guess that's the point I want to make. It's so hard to know to begin with. So I just want to make that point so everyone can understand, like it is a bit of a level playing field to begin with at the end of the day. Then you say, why are you even doing that? But like at the end of the day, if you do want to have a view, it's not like there's some huge edge that people on the outside of the oil community aren't aware of.
I mean, but within that, so say when you mention like, if the trade houses are bullish Q3, I very much doubt that that's reflected in a flat price view. Right. They'll probably long like Q3, Q4 spreads or like probably like a structured trade. Yep. I don't think that would have been expressed at flat price.
No, but it's still a consensus view that's easy to get access to. So it's not like people are hiding around saying we're bullish Q3. Like everyone's talking about it, and as you said, in some way they're trying to reflect that view. Yeah, it might not be in flat price, but again, I'm trying to make the point about a consensus forming, because the one thing I think people accuse the oil market of straight away is I don't understand it. You guys have all this information. It's an unfair. I'm like, is it? Because I see all the same views from guys in the minutiae and guys at investment.
I guess
banks and
with
all
that
that.
as well, maybe there's a question around the timing. So you're saying everyone was bullish Q3, so presumably everyone buys Q3 flat price maybe.
Yeah, or Q3 gasoline or Q3 whatever, right?
But then when's your timing on getting out of that trade? So everyone's bought it,
Yeah.
and when are people going to start looking at Q4, which is potentially oversupplied? So you almost want to be getting out of the trade when it's reaching peak consensus and kind of be aware of those views.
And how do you know that? Well, that's more of an open interest thing, right?
Well, maybe a thing of going around and talking to everyone as well.
Yeah.
So like, I think that's a pretty decent way of getting a gauge of market sentiment.
Yeah. But right now, if I was sitting alone outside of the oil industry, and actually I didn't even have the money to buy subscriptions and all that, I still know just by looking on Google, I can find out what the market believes on a consensus point of view. Then I can say, well, actually, if I look deeper into what's publicly available, we even produce the the swap side of things about commitment of traders. There's the CFTC commitment of traders on futures. So now you can get a good idea of how people are positioned.
Yeah.
And as you said, like where they are in that cycle, like if it's priced in, that means, ultimately how many people can buy in a given market and how many of them have bought so far. You can actually find that information out publicly. So you can do what you're saying without needing some incredible edge, some incredible like physical asset information. See my point?
Yeah, well, maybe we should try it. There's probably a strategy selling peak consensus.
Yeah, taking the other side, but that is our job, right? We're looking at the market as market makers. We're flow specialists and you're relative value specialists. So we are looking for these kind of relative value trades, even on both sides of what we do. And our job is to be in the minutiae. Our job is like being right there at the final kind of trade. So we're happy to take pennies and have large volume. But I would say generically, again, going back to generically what people are trying to predict, they're not necessarily, even if they don't make money or even if they are not looking, maybe it's not their job to make money, they're still trying to forecast oil. They're still trying to talk about oil, like where's it going to go? So can we agree that point that it's not actually that hard to find out the information you need to find out at the same level playing field?
I don't think it's hard to
basis.
like to see what like a generic market kind of consensus view is. I think I'd agree it's probably quite easy to find that.
So there's no reason for people to fear like the outright price in terms of information, but they should fear it from a trading point of view.
I don't think there's an issue finding the consensus view, but I wouldn't, if anything, you probably want to be the other way. Like you wouldn't want to be doing.
So let's talk about that then. So basically, we came into the year and as you said, like flat price wasn't a huge trade for the industry, was the talk because 2023 was a bit rocky, but nevertheless, there was a kind of bullish consensus. So majority of people put their positions in Q3 product cracks. Now, again, that was publicly available information, right? That was Bloomberg, Reuters talking all about it. It was record open interest set in Q1 for a Q3 contract. So in other words, people piling in like way too early, or not necessarily early, and then, there's a long time to wait, which can have its issues. And then the $10 per barrel sell-off we had in Brent, but also just general weakness kind of in the last month or so. To me, I think you're going to talk a lot about like, the real underlying demand issues, diesel, like China, probably things like that. But would you agree that the sell-off we kind of had initially and in the back end Brent spreads, they all went down to like single digit and the move happened in line with kind of consensus changing? Or do you not agree? You think it was happening way before then?
I'd probably disagree. Okay. I reckon flat price started to move down and then, which probably reflected like falling refinery margins, probably reflected very weak demand for certain products.
But when you say reflected, as in like...
So I reckon like people with real-time information, and we were hearing it as well, like, I might speak to people who run tanks in different countries, and they were all like at the very beginning of the year, they were saying, particularly for diesel, demand was very weak.
So they were actually speculating short diesel, and that was finding
they weren't necessarily saying short diesel. They were just commenting that demand was weak. So like I think we were already hearing that very early on in the year that demand was poor, and I think the industry knew that and was seeing that.
How does that filter into flat price? Like you say, if they're not speculating.
I think to flat price, I in my mind, it's kind of fed through refinery margins. So beginning of the year, refinery margins were super high, and they've come off as, I think as we've been building product stocks.
Yeah.
As you said, there was a massive and probably quite crowded trade being long Q3 EBOB cracks. So like, I think people were looking at previous years as well where EBOB exploded and looking to kind of repeat the same trade. And people got into that trade, and I think demand's massive, like demand's disappointed. And we've then seen quite a violent unwind, or we saw an extremely violent unwind as people kind of got out of those trades.
Do you classify the sell-off as a risk-off trade that essentially those longs that were there were unwinding?
On the product side, yes, yeah.
Okay.
I think diesel's a bit different because you have massive airline hedging flows down the back, so that arguably inflates diesel cracks down the back, and then you have a spec community who tends to kind of sell jet diffs and jet cracks down the back.
Yeah. I still don't understand how that leads into flat price though, and someone needs to sell for it to go down, right? And ultimately it was hedge funds.
I personally, I think, I mean, people probably saw product cracks, and maybe that translates through into flat price.
How? It can't, right? Is it like
I think via refinery margins. So like, if refinery margins come off, refineries start to cut runs. You see that then translate into like physical crude markets. And I mean, we're definitely seeing that at the moment. Like, demand's so bad for all the products.
I know, but someone literally, like, crude can stay inflated for forever if it wants to, as long as people keep buying at that level, right? It can expire, a few dollars below that when it gets to physical expiry. But ultimately, as an M1 rolled position, like Brent can just stay wherever it wants to based on the net positioning of the market, right? Someone has to start unwinding. So I was going to just say, from the evidence, it's, the hedge funds start to get short, and then the CTAs start getting max short because they're just trading the downward momentum and they've got like a lot of swing positioning. So that accumulation of selling was ultimately what led to the sell-off, right?
But why did the hedge funds start to get short?
Because the consensus was changing.
I disagree. I reckon the consensus would have been led by what we were actually seeing on the demand side. But
okay, another piece of evidence for me is it was the Cal 25 spreads that moved, not the prompt Brent spreads. So usually if you have like a big structural move, the Brent future will move up and the Brent spreads will move up at the prompt. But actually Brent spreads at prompt kind of stayed stable, reflecting like decent North Sea like economics. But the Cal 25 spreads got destroyed, like almost went, actually they did go contango for a time. And why was it so localized to Cal 25? Because the hedge funds are reading, well, 2025, the demand's not going to be there. The IEA is saying the demand's not going to be there. Goldman's are actually saying, they've recalibrated, they think it's going to be the lower side of the range. So how do you reflect that view? You put it in Cal 25, not in the prompt, because you want to see it reflected in Cal 25.
I think possibly that the spread move we've seen as well is like, we recently saw that, I mean, the market's maximum short, right, or was like last week in the...
Yeah. So now a consensus formed the other way.
But that short would be in the front. Yeah, so like there's been a huge amount of selling by CTAs, funds at the front.
Sure.
Whereas down the back, you've probably actually got quite a lot of consumer length, maybe largely in diesel and like fuel oil.
Sure, they could trade the front, but they can still marry that trade with a short Brent spread position in Cal 25. So that's another trade, right? Hedge funds won't just trade outrights, they'll trade the spreads, as in as a reflection.
Well, in my mind, there's been a huge pressure on structure because the shorts have come in at the front.
Yeah.
And you've got longs at the back, sticky longs at the back, which are just
but
consumer
hedging. Held in the front.
So the front few months have held, which I'm massively perplexed by. But every other kind of spread in 25 has been seriously pressured, and I mean, arguably getting to quite attractive risk reward levels, depending on what your view is on balances. But I think it's extraordinary. The difference between the front few spreads and where the rest of the spreads are in 25 is like.
But do you not like my hypothesis? So North Sea fundamentals are what they are, but ultimately the spread prices in the prompt basis what the trade houses and the majors who control that oil flow do, right? And ultimately they can see that it's quite easy to price it, 60, 70 plus cents at the moment. No matter what you say about the fundamentals, it doesn't matter, right? The North Sea can price at that level. So it kind of has to stay there because they know anything below that, they'll just buy it because they know that they can settle it higher. Whereas the back end, it's all speculative, right? It's all in the future.
Yeah.
So as a hedge fund guy, you'd be mad to sell the front Brent spread into expiry because you're taking on like Vitol, Trafigura, Glencore, all these guys who are actually going to control the North Sea flow. So how do you trade a time spread view in a macro kind of view basis? Well, then you use deferred spreads. So they sold the deferred spreads, flat price went down, and it turns out the selling came from the hedge fund. So all aligned to me that as the news was coming out, like we just don't think this market's going to hold up, and the big influencers were saying that, well, look, now the back end spreads are starting to weaken and the hedge funds are getting short. So that, I'm not saying it's right. I'm just saying like that seems to add up as what happened.
Yeah, maybe that's right. I mean, personally, I don't feel like the front few crude spreads are a reflection of what the fundamentals are going to be.
That's exactly what I'm saying.
Yeah.
So people do know that. So again, I guess talking to a few different audiences, but the one big thing I'm trying to get across is it's not that hard to get the information to know what the same view of the big dogs, if you like, think. And another thing that people know industry-wide is you don't trade the first couple of Brent spreads for your view fundamentally because of it's all about the North Sea. That is known. So as in like, as you said, like the prompt is very different from the back end, but they wouldn't have touched it anyway, right? Do you see my point?
Yeah.
And maybe that is less well known outside of oil community.
You're kind of talking me out of my front Brent spread position.
Right, okay. No, but that's the other thing though. Like, I mean, that's a whole different discussion, but when you have supply and demand linking to the derivative price, what links it ultimately is when the price is settled, right? So the expiry mechanisms we have, that Platts and Argus and, you know, all these companies, their job is to say this is what the final price is. They use real physical prices there, but only at the very, very end. So you can just completely avoid that real exposure by rolling it down to the next month. But even when it aligns in the front, the physical can actually be a little bit irrational for a while until people kind of run out of ammunition, people run out of like being able to kind of justify these prices. And eventually you do have a fundamental correction even in these like kind of niche trades. Do you see what I mean? So front Brent spread will have to make sense at some point is what I'm saying.
Does that make sense with what you said that they can make it price wherever they want?
Yeah.
So why?
So one day of it. So let's just say they price it where they want, and it's way higher than so it's 70 cents when the whole real market is flat.
Yeah.
Well, or the wider market is flat. But if that then goes down to -20 and they're still 70, or -40 and it's still 70, at some point it'll be too costly. It'll be too dissociated.
Well, you'd hope that at some stage there was enough of an incentive for someone within that kind of group to push, to just take the opposite view.
That's
and
what
put
I'm
on
saying.
a bear plate.
That's exactly what happens. But it can stay dissociated for a while until it can't. And I think that tends to happen towards the end of the year because they've essentially not run out of money, but you know, everything works really on calendar cycles. So you get to September, you probably know if you've made your money or not to some degree. And if you're still fighting to make money, then you will probably be like, look, we need to.
I think a lot will depend as well, just on the fundamentals. So like if you are in like if you are running your physical book in like a bullish kind of play at the front, but you start to see the fundamentals look really bad, then you don't want to be the last person left holding that kind of overpriced long. So maybe that's what we'll see.
But do you see my point in that, like, it's more likely to happen at the end of the year because the kind of ammunition, if you like, that's needed?
I think definitely as you come to the end of the year, there's a working capital issue at a lot of, like particularly around, you know, towards the end of December. People don't want to be holding inventory. So you often see quite a few spreads. The deck Jans kind of get hit towards the end of the year.
So we could look at it another way, like again for, you know, the industry and outside the industry rethinking, you know, what's the modern way of looking at oil markets, right? It used to just be supply and demand balances and whatever, that's going to link to prices. I think there's enough understanding, like even Bloomberg yesterday were talking about swap dealer open interest being really high. And this is quite niche stuff. So the consensus is starting to move to like a more deep understanding. But essentially what you're trading Jan to December when you're looking at oil and you're actually looking at oil prices, which might be nuts because ultimately those oil prices are what dictates the prices for obviously the global consumption price. So it's a really important thing, but it's dictated not by, I would argue, supply and demand. It's dictated by the net positioning of traders and as you said, the working capital of traders and the net result of that. So you come in the beginning of the year, right, what should oil prices do? Well, everyone's looking, where do they put their chips? And you make the point, you shouldn't be speculating, but I would say there's enough hedging in the outright prices, like it doesn't really matter, right? Everyone kind of needs, or a lot of people need to have a view whether they should be or not having one. So they then put their chips, if you like, their working capital into a consensus position or into a position they feel comfortable with. And then the market then plays out off the back of that. And even when you get into the time spreads, the differentials, it's kind of really the same thing. It's people have views, so they start to buy contracts. That causes a rally, or that causes a sell-off if, you know, people are too long one way or whatever. You could keep going through it. But the point is that at the end of the day, it's important to know that psychology rules all, because psychology filters into how working capital is deployed, and the price is determined by the net result of that. Does that make sense?
Yeah.
It's a bit, I know it might sound obvious to you, but as in like, if people can really get their heads around that, then you won't obsess so much about, yeah, but I heard that there was like an air conditioning spike in demand, and yeah, that might cause a temporary shift in sentiment if it's near a region that is really important, like Saudi Arabia. But realistically, what you're trying to do most of the time is gauge what everyone else thinks, gauge what, you know, even like the Fed and the macro's doing, to kind of gain a view about really what's going on or will happen to the contracts. And that's how you should be trading, not going, well, what do you think about the S&D though? What's the balances saying? It's like, do you even need to run your own balance? Because you can go out and find what the top balances out there, or the most reputable balances are out there very publicly. Do you see my point?
So personally, I think, I think most of the big physical, or most of the big traders out there, be it the best hedge funds or the best physical houses like trade shops or oil majors, are running quite detailed balances.
Yeah. But why?
To give them a view on what they think is going to happen to stocks.
Yeah.
And they will compare that to what they're seeing out there in the market. But I think the key step then is you have a physical view a forward view on what you think is happening with stock, is then how you express that. So like, say your balance is super bearish, but the price is super low. Are you going to go out there and like sell something that's dirt cheap? You're not going to do that. So I think that's like an iterative process.
That's when trading comes in. That's when it's like the difference between a view and a trade.
But
right?
I think I think that's happening at every single. I think anyone who trades in the way where your balance looks bad, I'm just going to go ahead and sell. Over the long run, those people kind of get taken out of the market. So I'm pretty sure everyone is looking for where there is a disparity between what their balance is saying and what price is saying.
Yeah.
And as you say, you have to get more and more intricate. So as the market gets better and like it gets more competitive to make money, you have to get more nuanced in kind of how you deploy your risk. And I think that's what everyone's doing.
No, I love it. I'm glad, like that's a very articulate way of putting it. And that to me is what, the search is. Again, I'm always on the side of, I came from a company that had absolutely no physical information, and I'm still at a company that has absolutely no physical information, and we've only ever made
and
more
the trades
and more
extremely well and it's profitable.
But even on a view basis, I've never seen like, oh well. But
so I completely understand your skepticism and like kind of running into this. I did think about it, and some of the biggest losses I've ever had have been trading a balance. So I mean, running into IMO, I spent my entire career, about 5 years, working on what was going to happen in 2020, and I built what I think was the best balance anyone had in the market. I mapped every crude field in the world to a crude assay, and I had an amazing view on exactly how much low sulfur fuel oil was available globally. Okay. And so based off the balance, I got massively short 0.5 diffs. I was super bullish high sulfur fuel oil.
Interesting. That way around.
So it was a contrarian view. I was massively short the 0.5 because I thought there was way more than enough supply.
Yeah.
And I basically stopped out kind of that December, having had like my biggest drawdown.
So wait, hang on. So the consensus view was that 0.5% would be a new contract that would be
the consensus view. There wasn't enough.
Yeah.
0.5, and the price skyrocketed, and I thought there was, and I thought like high sulfur fuel oil balances would actually tighten up.
Yeah, but that did work out.
It is what eventually happened.
Yeah.
But I guess I was too soon into the trade, and didn't.
No, this is like a perfect demonstration of
So,
what we're saying.
well,
right?
yeah, on occasions, that I think you're right.
You knew exactly what you were doing with the. I'm not trying to say how obvious it was. I'm just saying, even from, again, the generic observer, or not generic, but someone not deep into the physical, you're just saying, okay, what's going on? So 2019 is when everyone was, or 2018 and then 2019 more, was when people were starting to pile into positions for the 2020. So for the shipping, changing those regulations from high sulfur to low sulfur fuel. And the trade was in the industry it was so easy to find out what that was bearish high sulfur cracks. And actually wasn't low sulfur, because that contract didn't really exist, and it was such a finger in the air thing. It was a bit like hydrogen now. It's like, where is green hydrogen? No one really knows. So the real trade was buy gas oil, sell fuel oil, high sulfur fuel oil.
Or buy LSFO, sell fuel oil.
No, but
Sorry, the 1% fuel oil. So that's that.
Oh, sure, the high.
So people, No,
you're again, because you are deep in the industry, so you always think like that. But I'm saying go even wider. It was gas oil, fuel oil. And the reason why I say that is Pierre Onderon had that trade on.
Yeah.
He had a huge hedge fund position on that. I think surely other hedge funds must have had that on as well. Yeah. And everyone was talking their book. You had like a whole, endlessly in the news, gas oil needs to rise, fuel oil needs to stay. I was at a conference in Vienna, of all places, in 2018. And BP actually came out and said that. I don't know, wonder if you were linked to it at all. And they were very public. Yeah, we think gas oil is going to rise and fuel oil is going to weaken. This was before the initial move. And I thought it was fascinating, because I was like, right, so no one knows what's going to happen. So BP come and say, this is what's going to happen, which is exactly what they
fairly early on.
Exactly, that's exactly what they should do, right? That's like giving people clarity on it. That's like their opinion. Like it was like what needed to happen, because no one had a clue. And then throughout 2019, there's this explosion in the gas oil cracks, an explosion in gas oil versus fuel oil. So people are making money. A market maker, we weren't trading gas oil at the time. They actually sold into this and it didn't work out for them, and they actually ended up closing down. But the point is that I watched this play out, fascinated. That was the definition of a bubble, right? So someone decided that gas oil, fuel oil was the trade. If you look at the price action, it was like da-da-da-da, and then whack. And then everyone started talking about it in the media. And if you're an investor, if you're retail, whoever, you would have found out about it and you could have participated in that trade. When it actually got to 2020, it completely unraveled and the bubble just burst. And then at the end of it, I was like, why was anyone trading gas oil anyway? I know there was physical changes to gas oil, the blending components.
Gas oil made sense because there wasn't, if you believed the theory, there wasn't enough 0.5 supply. So you had to use gas oil. But as a blend component into 0.5.
Was that factoring in using condensate and lighter crude and blending that?
I think in my mind, the eventual solution was using very low sulfur heavy crudes, which they're quite niche, but there are a lot globally, and it was just about segregating those.
That's the real physical stuff. But again, going back to the derivatives and the consensus view, for a whole year and a half, you could have had that view and made or lost money. Shell, actually, they don't usually do this. They publicly said we made $1 billion on that trade. And then they unwound it before it got to 2020.
Yeah.
So they just participated in a bubble that burst, and it just went back to normal. So what happened for a year and a half? Just people talking their book, people talking supply and demand, and it was all just a fantasy. And
it wasn't a fantasy. It was definitely real.
But gas oil, fuel oil, what do you mean it was real? As in
As in that they did need to.
But 2020 contracts went from I think the actual diff went from something like 18 to 40, and then burst down it. So in that time, it was all Cal 25 Cal 20 that they were focusing on.
Yeah.
So when it actually priced, it went back down to 18.
Yes. So I think what happened is you needed a massive incentive to refineries are pretty slow move. I'm always disappointed by how long it takes refineries to respond to economics on if you sum them all together. And you need price signals to tell refineries what to do. Then they kind of react retrospectively. So
let the derivative play out, market play out.
Yes. So you need a certain price move to happen.
Yeah.
I think where I was wrong is that I saw a decent price move, and I thought that was way more than enough to incentivize refineries to change. And I probably thought, I did. I thought that they were going to react quicker than it actually took them to react. And I think, as we often see in markets, particularly now, as you get a massive overreaction. So everyone piles into that trade. No one can be short. So you have quite a violent spike. And the price way overextends and probably went way through where the fair value should have been.
But then it's again, any point of financial markets, it's like, what is the fundamental justified level? And we're constantly in a state of overbought and oversold around that. So that's when you're getting into tradecraft and thinking about like open interest, as you said before, about being more and more clever about it over time. And that is what the new trading is all about. I think you said that really well. But or I wasn't trying to mug you off for that position. In fact, I was actually. I'm just trying to say.
I just should have held it. I mean, I literally stopped out at the worst possible. Like,
fine, but for me, it was just fascinating that everyone was seeking a justified supply and demand balance view to react, when really how it played out was just consensus positioning that ended up. It doesn't matter what happened. It's not like I'm judging it either way. It is what it happened. But it's just when people say, "But I need a good S&D balance, and that's 100% the way I'm going to trade," that has to be dead. And I know you're agreeing is kind of dying out.
I disagree that it needs to be dead.
No, as a singular point of reference.
As a singular point of reference,
yes.
Yeah, completely agree. It's part of, and I think a key part of how you form a trade view. But yeah, without a doubt, it's not the only thing. I mean, there was another story earlier this year, like the best hedge fund had an enormous gas oil crack short, and like
this year,
beginning of this year, yeah, like repeated like 50. They were short 50, apparently short 50 million barrels of cracks. And by the time they lost a certain amount, by the time they'd finished stopping out, they'd lost 500 million. And like, I think the trader moved on. But that view actually was right. So like,
but what does right mean?
Post-stop,
so this is where we differ as well.
Post-stop out, the price collapsed, and diesel's actually been super bearish. So like, had he held the trade,
but it was able to rebound probably because he stopped out. The open interest became more balanced. There was liquidity there for it to actually. Do you see what I mean?
I think he was just. I think it was around the time. I mean, that Ukraine was like, sending drones over and like bombing Russian refineries, and I think, as you say, sentiment's also massively important. So, the market was still fairly tight. He was probably in the trade a bit early. Sentiment,
but that's what I'm saying. So even if you say, yeah, but it's just derivatives, like no, you just said that refiners and physical players make real actions based on the derivative market. That's how big it is now, right? So the derivative market sets the physical price that has real physical ramifications. So you can't just like dissociate the two.
So I mean, there are a couple of examples of where just blindly, like, and not necessarily, I mean, maybe it was blindly trading the balance, can lead to like huge losses, and it's that style of trading where you're taking a big outright position and you're sticking with the trade because you 100% believe in your fundamental view, and that can create some of the biggest losses I've ever had myself or seen or heard of, but. Still, I think there's countless times where actually building a balance and forming a view and putting the trade on has actually led to enormous returns as well.
I think on a macro, wider, long-term scale, agreed. So like 2008, the big China boom, right? Like China going to be buying a lot of crude and essentially was the trade. That was made explicit from the balances from my understanding, right? So if you ran the numbers and you saw the rate of growth of China, you saw the rate of growth translating into the rate of buying, it was just going to completely outpace what was able to be brought online. So that was a 2-3 year trade in the end, like buying from like, I don't know, 40 up to 140. That I completely understand. I completely agree. There's like a fundamental mispricing there, but I still don't think these things can happen without, how are you going to get long if there are no sellers? So there has to be almost a sense of, what is the market not expecting? What is your S&D telling you? Whatever your reasoning for review telling you, and then what should happen because the market hasn't expected it's going to start needing to reverse their positions, yada 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 yada. That's trading.
Yeah.
But it's what dictates real end user physical prices. So we can't just dissociate ourselves and be like, but you're right or wrong, because there is no right or wrong. It's just what the derivative price does. Do you see?
Well, I probably disagree.
Yeah, that's fine.
I mean, I think there is that's why I love trading.
Yeah.
At the end of the day, you get a number that may be a positive or a negative number, but there's no kind of bullshit in that number. Like, you've either called it right or not.
And then, okay, fine. So let me play on your side then, in terms of, okay, so if I have to form this balance, and it has to be, useful for me to trade, and I've got enough information, like you said, you were able to get like one of the best balances in the world together. But then
The best.
The best. Did you bring it here?
No, no.
It's because I don't believe in it. Yeah. No, but then
No, I had to leave everything. Like, I've never taken.
I'm joking.
I could rebuild it. Like I'd need something.
But my point is that how do you ever know that's true? So when you do a global S&D balance, that's every single barrel that's consumed around the entire world. At what point do you go, my balance was the best in the world?
I think so. I mean, you can just track. So I think in my mind, the best way of doing that is so every model I used to run, I'd like freeze it, take a copy of it every week, including my forward view on where I think stocks would be. And then you track over time how good your model has been at those kind of forward
it's
views.
About predicting
and how it's
stocks.
Yes. Yeah. And you can track the evolution of your forward forecast. And sometimes that may change for a completely justified reason, like price has gone up or you've had some new inputs on demand or something like that. And then that's quite justifiable that your forward view would change based off that. I think you need to track over time though that the kind of the errors within your model. So is your view changing because actually you've got something wrong, or is it something that you should have foreseen which you didn't? So I think you can, and I mean, definitely at one of the places I worked at, you would do so every month. Every analyst had to give their view on what the IEA stock change would be before it came out, and that was kind of how they referenced. I mean, I think there's a lot of errors with that as well, but it's just one way of trying to reference how well. Like people are,
and I guess to do this well is a hugely cumbersome task, right? It's like you have to put a lot of iteration in and whatever. So I can understand why people value S&D the way you describe it, just playing the devil's advocate. But ultimately, another thing I'd like to just finish with is like, so why do we need to, like, is that information when you pay a third party to do it for you? Is that the same gold it was before? Do you think people will keep paying for that, given you've said that the majority of the time is you're using an S&D balance that you hope is actually different to what people think?
So I completely understand your skepticism, and it's...
I'm not saying I was skeptical. I just said, I'm asking the question. It's a very big business right now. You've got like Kepler, Energy Aspects, other businesses that together are worth like, I don't know, 2-3 billion. Or if you include Platts, like even more.
Yeah.
So,
and I think we probably, so I agree. Like, I mean, it's massive. Those valuations are massive, and the fees that those companies charge are enormous. And everyone now buys that data. So I think you're completely right that there's a massive question mark over, do you actually get value out of that data because everyone else is buying it? So how are you monetizing? What's the edge in that data?
Well, it might just be they're getting better and better at it. It takes a lot of working capital to put this together, and it's such a good reference point relative to your balance. I think that would be the main argument. But at some point, my argument would be, where is the, I don't know what the point you call it, where it's so straightforward to access that information that basically you can't sell it anymore. Does that come a point? Because then the oil industry has had those points with other data sources, right?
I reckon if you're talking like peak like return on analytics, I'd probably agree that we've passed it. So like everyone now actually builds the balances themselves and buy a lot of this data, and they then build their balance. And like, are they managing to monetize that balance and actually make a return, including all the analyst salaries? Like, are they making a return or not? I don't know. So like, I suspect it's the very best. So maybe the top 10, 20% of like houses who do it and do it well are probably managing to do that. But I expect there's a lot of places, and that's probably some like the not particularly good oil majors, like who just have extremely profitable businesses anyway. So maybe aren't that careful on their like bottom line costs. So like running balances and like paying a whole lot of
they take it as a point of pride to know the information, and it helps maybe with their customer
and it's probably quite nice. Like
relationships.
you could use it for that. Like you have a nice weekly meeting and go through it, and maybe it gives you a bit of help forming views. But I suspect it's not.
Can I just, if I take it to a different market then? So what would the equivalent be on the macro side? Like you've got basically realistically 200-300 years of study in economics about global economics, right? Trade balances and the rest of it. And you have central banks, you have some of the best minds in the world go into these areas to be predictive so they can assist monetary policy and fiscal policy and all the rest of it. And they don't see recessions coming. People talk about that all the time. Yet all the best minds and all the iterations in the world has come, and it's still, you can almost argue at both sides. That's why you always need research and to get better and better and better. Or that's why it's never worth really hanging your hat on it, because it's no matter, even if you get to use a hugely saturated market, like, I guess like global economic, however you want to define it, like at the government level, and you're still not able to predict using that. So it's either not very useful, or you could say, well, no, it means you need to keep paying to get.
I think in my mind, it depends on how good you are. And maybe often that will come down to the individual
but from
analyst.
A government perspective.
From a government, I suspect they're the least well-paid analysts, and they probably have the worst like analytical teams out there. But
you're talking about oil now, but I'm talking about
like macro government, whatever, like interest rates or. But you probably look at some of the very best hedge funds who are paying the best analysts in the world. Yeah. They probably actually make quite a lot of money versus the market predicting a lot of the macro trends. So like, and some of them are quite, like some of that, a very kind of discreet and non-public funds. So you would probably.
So in a way, the third-party research job is to catch up to the latest innovation from the hedge funds.
I guess they're trying, but they're always going to lag because the highest paid.
But then they're always going to exist then, by definition. Do you see what I mean?
Who
Well, we're always going to want to pay for research because there's always going to be a company.
I think they'll exist, but you're probably not getting any value from that research because the people who are at the forefront and running the very best analytics are going to be making money out of it, but they're just always going to be a step behind, I think.
Well, what I hope to see, as hopefully retail get more involved in the oil market and investors, is that essentially as more and more smart people kind of treating oil analytics as open source. So they go out and publish there's loads that are already out there, but the more and more people do it.
So I think that's interesting, and there's definitely been a trend for that. So say that, at one of the big oil majors, like 10, 15 years ago, they were the first people to start to build a comprehensive database of vessel tracking. So every vessel on water, they had about 100 analysts, which was insane, like 15 years ago, tracking every single vessel for every single product on water.
Wow, yeah.
And they have a huge trading network, so they could figure out every single vessel, what was on that vessel and where it was going to. And they were collating that all together. Desks were sharing that information with each other. And that enabled them to have the best balances by region, because they knew what was going to each place. That idea has then gone out, and you've got Kepler, you've got Vortexa now who've commoditized that product, but that oil major who's at the very forefront of that made a huge amount, and until that now became commoditized. So from that respect, I'd agree, and that probably is happening with other data sources as well.
So that's where we go. So it's just about moving to research that just goes to the next. Whatever it is, like it might be a new data source, might be a new way of analyzing.
I think the issue is it becomes commoditized, so everyone can buy it. Everyone does buy it, and then. But
then the market gets smarter, and then you go again.
Well,
right?
I think you lose your edge. So like, I think we're definitely in a situation now where, because everyone's buying a lot of these data sources, there's quite a valid question on whether or not it's actually worth buying them. And I think if you're a massive trade shop making huge amounts of money, then you can afford to pay because it's not paying. A few $100K here and there for each subscription is nothing. But I think if you're a smaller trade, a smaller place like us, do we want to spend, $100K on Kepler? Do we want to spend $150K on industrial information resource? Like, it's a much harder kind of. Are you going to get an edge from that data that justifies the investment? And it's probably not.
No. All right. I think. Went through a hell of a lot there, so I really appreciate your time, James. And again, I'm not even really sure how to conclude all that, but it's worth debating these things all the time because the market getting smarter, the market evolving, becoming more innovative. If I think now compared to where started Onyx, or even where you, let's say from Macquarie and before that BP, how much the market has evolved, it's always fascinating to just kind of discuss the kind of where we're at now. So
that alone, I think, very, very interesting. So thank you there.
And thanks everyone out there for listening. See you again soon.